Morning everybody, and thank you for joining us for the webinar today. My name is Murray Anderson from Prescient Investments, and joining me today is Henk Kotze from our investment team. Henk looks after our cash and income portfolios. Welcome, Henk.
Murray, and welcome everyone.
Yeah, thank you. Henk, reason for the webinar is to talk about global landscape. Particularly, we'll focus on global interest rates, and then we'll delve into a little bit of product, how clients can access our investment capabilities. But before we get there, let's talk about global interest rates. I think this is probably the most hotly debated topic globally at the moment, so naturally we should be talking about it too. We expected interest rates in the US to be cut, but it seems like we're going to be on pause for a little bit longer. Do you want to reflect on the interest rate environment and how we see things playing out?
Yeah, I think it's a great sort of starting point for the webinar. And from our perspective, yes, rates are high. Coming into this year, we were expecting them to come down sooner and by quite a bit more than what the market's currently priced for. So I think as we came into this year, 5 cuts priced for the US, now currently not a lot more than 2. So quite a significant shift. And why that shift, right? So what we have seen is, one, on the economic side, so the GDP side, we've seen some strong numbers out of the US. So the expectation that the increases in rates would have sort of stalled the economic sort of situation in the US has not come through. And then more importantly, on the inflation side, inflation's been arguably a little bit stickier than expected. Yeah. We differ a little bit from that view, so we are a little bit more bullish on that front. So we do think rates could potentially come down quicker, specifically on the inflation front. So we've been singing the song for a while that inflation is driven by shelter. Shelter is the biggest component. It's contributing 80% of the current sort of number, and that's going to come down if we look at sort of all the leading indicators of where shelter is going to go. If that comes through, then yes, rates in the US should start normalizing. Should be a good thing for all of us. But while we have these high rates, I think the opportunity set for investors in the global space is obviously one that one needs to think about. And earning 5, 6, 7% in dollars, very, very sort of risk averse, is what I think the opportunity is, and one we can exploit definitely through something like our global income provider portfolio.
Henk, so I think the point there is that interest rates are high. They have been high. We know they will be higher for longer. The cutting cycle will start at some point. We've called that in terms of the peak of rate cycles. But now, when is it coming down? You know, that's the next guess. I like the bullishness, but I think the point you make is that interest rates, certainly from a South African perspective, look attractive, and certainly short rates. So investors that do want to go offshore have been able to invest their funds into the less risky end of the market. Probably most people haven't gone to money market. Certainly we've seen very large flows into US-based money market funds. But I think the point we're trying to make is that we're able to do a little bit more. And that more is generating a higher than cash or money market return. And that's where the global income portfolio that we'll talk about comes in. So the expectation is that rates will get cut, but I think what's of interest to investors, and this is where we're seeing lots of activity, certainly from questioning, the advisor market that we talk to, and certain clients are saying, I'm maybe a little bit concerned about equity valuations and what will happen to equity markets on the back of the rate cutting cycle eventually. And also global growth looks a little bit under pressure. Those factors aside, I think the point is that investors are saying, outside of equities, where can I get a better return than cash? So let's introduce the concept of the global income provider. This is a fund that Prescient has been managing for over 10 years. Most clients would know us from our local income provider portfolio, but we've been running a global income provider for a good number of years. And I think the interest there is, as I repeat myself, higher than cash money market return, very attractive for investors that are maybe risk averse or looking for a more balanced portfolio globally. So let's talk about the mandate of that fund and how we go about generating the return that clients would be interested in.
Yeah, absolutely, and it's very topical. So over the last sort of 12 months, we've been working hard on enhancing the process that we follow when it comes to managing the global income fund. So historically, the way we thought about it, very similar to the local fund, we've got a real return target. In this case, it's US CPI plus 1.5. Okay. And then more importantly, on the risk side. So yes, we can go offshore, and there's a great opportunity set there, but one needs to be cognizant of the risk that you take when going offshore, specifically in the sort of form that the income provider would take, right? So the risk characteristic there is don't lose money over 12 months. So very similar to the local fund, a little bit longer horizon, obviously with a little bit less yield that you can generate, but the return and yield component and the risk component is very similar.
I think, sorry, just interrupt, the key points are this. The risk management, don't lose money over 12 months. That talks to the conservative client requirement of give me a return. So you're saying US CPI plus 1%, which is attractive, higher than the money market rate you'd get. So still getting a real return in, post-dollar inflation, good risk management metrics, solid sort of fund from that a conservative client is looking for.
100%. And if you think about the opportunity set of going 45% offshore, there's obviously a big place to play. Mm-hmm. And historically, what we've done in that space is to focus on South African counterparties. And the reasoning behind that is twofold. One, we do believe that we are strong in understanding South African counterparties that issue dollar debt. Mm-hmm. So that universe is one we wanted to tap into. But secondly, and almost more importantly, we don't have a team of 100 analysts to go and analyze 15 to 20,000 different opportunities in the global space. We argue that very few people in the SA context would have that, even in the global market. So for us, it's more about trying to find asset location opportunities in the offshore space, analyzing those in the systematic way that we do locally, and then exploit those opportunities in the global space. So what we've done over the last 12 months, as I said, enhancing the process, is moving away from focusing only on the SA opportunity globally and widening that net to now start to incorporate different opportunities in the form of ETFs to get us that exposure that we want, to get our real return target within our risk framework. And the reason we've been able to do this now and why the change is that we've seen global markets develop and evolve. I mean, locally we've seen it now with the launch of actively managed ETFs. I mean, we've got one on the income side as well. Mm-hmm. But globally, the uptake of ETFs and the availability of ETFs is fantastic. It's very efficient, it's very cost efficient, it's big, large liquid markets. And we have the ability now to take asset allocation views on those and form a portfolio that's optimally positioned for the return and risk that we're trying to achieve.
Okay. So Henk, I think the couple of key points there is that going offshore, obviously from a diversification perspective for clients is beneficial. The type of mandate we're managing, looking to protect capital but deliver a better than money market yield, you're open to a much wider universe. And I think that's the critical point. And maybe to emphasize from a systematic process that plays into our hands. So you're managing global income portfolio from Cape Town in South Africa with the ability of anybody else from around the world. The process that you talk to has been enhanced to include a broader set of instruments. Shall we dig into those and just cover a little bit about what that looks like? Absolutely. So that people have an understanding what the ultimate asset allocation mix would be?
100%. And yeah, let's show them live on our portal. Okay, so as discussed, being a systematic investment manager, we really look at the evidence, look at the data, and try and find the opportunities within that space to build portfolios that, one, reflect the return objective, but most importantly, but most importantly, reflect the risk objective of a portfolio. But what does systematic investment mean? Just a very sort of high-level run-through again, just for everyone's sake as a refresher. It means we're trying to be rational, rules and evidence-based and data-driven, which we believe leads to unbiased decision-making, clear strategies and processes, and then in the long run, consistent long-term outperformance. And that's really what we're trying to achieve. But just to get to the asset allocation story and why we have now enhanced the process to be able to take advantage of asset allocation opportunities in the global space is from research it was done in 1986. It's been updated very recently, sort of showing the same thing. But what we do see with this is that asset allocation really sort of predicts, or at least explains 95%, if not more, of your portfolio return. And it's that sort of 95% that we're trying to focus on, and not the 5% of stock picking in a portfolio that we're trying to build in the global space. So how do we go about doing that? So what we've done is we've identified a universe of assets. That's the different assets that we can invest into. Currently, we're focusing on 23 global assets, which represents about 15,292 different investable instruments. So very diversified, very large set of opportunities. And what's powerful about this is we can now form views, and we form views around all 23 of those asset classes that informs us how we want to be positioned. that will then inform us in turn what sort of return expectations we have, and then we can feed that into the system, at least into the process, to see how we want to be positioned. So what are these asset classes? It's all the sort of global income asset classes one would expect. It's UN sovereign bonds, emerging market bonds, corporate bonds in the emerging market space, all the way down to the sort of SA focused stuff. So we have not thrown away the SA flavor. It's certainly still part of the universe. If it makes sense from a return and risk perspective, it will find its way into the portfolio. So that's still very much there. And then we've also broken down, you can see the US curve very, very granularly in the front end. So 3, 6, 12-month depots, short duration treasuries, and then also ultra long treasuries. So pretty much covering the global yield complex in the asset class universe that we've identified for the global income fund. The question then becomes, how do we go from that step into building a portfolio? So the first thing we try to do, and what we believe is important to do, is to build what we would call an efficient frontier. So what we've done is we've taken the historic volatility, so we call it the risk of each of those asset classes, and then we've put it against the expected return, so the forward return expectation for each asset class that we can invest into. And then we've optimized for each portfolio that's going to give us the best return for unit of risk, and we've built the efficient frontier in the dark blue line that you can see there. So each portfolio on that line is already optimal. That's the important step. So now we've identified per unit of risk and return, what's the best combination of portfolios we can invest into. Just to break that down a little further, if we look at that efficient frontier and we go from left to right at the bottom here, you can see the expected nominal return, so from 5.4 all the way out to 7.8, and how the weighting to the different asset classes would change. So in the right and the frontier, it makes a lot of sense. You're taking a lot of very front-end 3-month deposits, and as you move along the risk curve, you can see you start introducing things like 20-year constant maturity bonds in the SA space, there's emerging market bonds, etc., etc. So all very sort of self-explanatory. Okay, so now that we've got this efficient frontier, the next step is to decide where on this frontier do we want to position a portfolio like global income. Okay, and that's this red triangle here. To get to that point, we could go into what we call the selection criteria. So what we've done is break up the selection criteria into 2 components. So if you think back to what we said on the return side, we want US CPI plus 1.5. So that's on the return component. But more importantly, on the risk component, we try and not lose money over 12 months. So that's where we get capital preservation as well as real return. We then went a step further and said within each of those components, we want a little bit more granularity. So what we've done on the capital preservation side, we said over 1 year, we want to be above 0. When we are under 0, we want to try and minimize that expected shortfall. And when we are above 0, we want to try and maximize the amount that we outperform the 0 line. So there's 3 components on the capital side, or certainly the risk side, and on the real return side, same. So when we looking at the US CPI plus 1.5, on a 3-year rolling hit rate, we want to be above that. And then when we're under that, we want to minimize the shortfall, and above that, we want to maximize. So that gives us 6 components or 6 criteria that we would score portfolios along the efficient frontier with, and see which portfolio would then rank highest on those criteria or selection criteria. We visualize it in what we call a risk web. So what we can see here on the outer ring, apologies, is the 6 different criteria, and then the different portfolios that score along those lines. So what we do is we rank each portfolio within each criteria. You can see the optimal highlighted here, scores really highly on most of the criteria. So how you want to read this chart is to see the portfolio that's got the highest area, so the geometric mean is the portfolio that you want to decide on finally investing into. Okay, here you can see the minimum variance portfolio, really the portfolio with the least risk, does well on some of the risk metrics, but not great on the return side. And then similarly on the maximum return portfolio, you can see doesn't score well on any of the metrics just because of the volatility and really breaking that sort of risk metrics that we're trying to achieve. Okay, so that's the selection criteria. Now we've set out the universe. It's a wide sort of sector that we can think about. We've created this framework, the efficient frontier. We've now applied our selection criteria, and what does that portfolio then look like at the end? Currently, the optimal portfolio has got about 6.6% of dollar yield, a duration of 0.6, so certainly very sort of risk averse when it comes to the duration component. Its minimum 1-year rolling is 0.77. So again, very, very capital preservation mindset that comes through. And the current portfolio, just looking at it from a sort of high-level lens, it makes a lot of sense. So it's focusing quite a lot on the front end of the US yield curve. Again, as we said earlier, obviously a very elevated front end of the US yield curve, a great opportunity there. So about 40% of the portfolio. It's looking at ultra-liquid investment-grade credit. So again, liquid floating credit in the front end of the yield curve. You can globally floating rate bonds, same theme, very little duration. US liquid high yields, 0 to 5 years, again, front end. And then where it's allowed to take on some risk, it's taking 1% of the 20-year South African government bond and a little bit of the 5-year as well. So nice diversified mix of assets, hitting our sort of return and risk targets, as well as just a very diversified, a very efficient portfolio in the global space that we think has been put together very smartly with the sort of philosophy that we run at Prescient, being systematic, believing in asset allocation and using the different tools we have to build portfolios.
Thanks, Henk. I think a very detailed, insightful review of the portfolio construction process, the philosophy, how you build up the portfolio, and obviously, importantly, the risk metrics or risk mindset around managing a portfolio like this. I think certainly from a financial planning perspective, when allocating funds offshore, that risk management, capital protection is probably the first port of call, and then one steps out looking for more risk via probably equity. So as I mentioned in the start of our webinar, I think clients typically allocate towards equities, but certainly those that are looking to place money offshore, or the more conservative client is saying, this is the type of portfolio that you'd look for to protect capital and certainly get a higher than money market dollar return, which is a good proposition to clients. And as I said, we're certainly seeing a lot of that interest in the marketplace. So global income provider, the client would take rands, convert it into dollars and invest in our fund offshore on one of the global offshore platform providers in South Africa. Certainly clients are therefore able to access this portfolio in dollar terms in a UCITS format. So I think that's a great option. We've mentioned it's been around for a while, but more recently what we've been able to do is launch a feeder fund into this portfolio as well, which is a rand-based, again for the same diversification benefits, conservative clients but wanting exposure to global income, not necessarily global equities maybe at this point in time, and therefore this is a great sort of structure from a domestic perspective. Any comment around the management of the funds and what you're looking at specifically?
Yeah, so I think it's been a great time for a strategy like this. Having someone that's active in that space is, I think, critical. The yield curve will start to shift, and you want a process that's going to identify the shifts and give you the best opportunity to get your return within that risk framework. Certainly a lot of interest from clients, be it direct into the UCITS or via the feeder fund, and we can't fault that rationale. We agree with the opportunity set. We think it's a great time for it. And as you said, rightfully so, I mean, our view on US equity is also moderately negative. We do think it's quite expensive. And as you wait for the opportunity, it's a great place to sort of sit and wait. It's very liquid, it's very diverse, it's very cost efficient, and the opportunity to harvest that yield is there. And I think it's one that investors should start thinking about.
Maybe just in closing off on the process and comment around the fund, I think the point that you make is exactly it. Is liquidity is high. The assets that you have in the portfolio, diverse mix, can be liquidated at any time. So therefore, providing those cash flows should clients wish for to take an income, for example, or move out of the fund into an equity allocation as and when appropriate. I think all of those metrics are important. Maybe one last concept about just to help people understand this portfolio. We often are asked to measure a fund against its duration limit or its current duration point of view. Maybe just a comment on that, because people need to get a sense of, the risk that one is taking in this portfolio, and if you don't mind, and or if there's any other way you'd like to explain the risk.
Yeah, so I think that we certainly at Prescient feel that duration is a very crude measure for risk. It's very one-dimensional. So you need to think about the selection criteria that we apply when positioning or constructing our portfolio. There we take into consideration all the different characteristics of risk that a certain instrument can hold, duration being one of them. So yes, having a 0.6 duration might mean something to someone, but the more important concept for us is the capital preservation. You could have a 0.6 duration by taking a percentage in 50-year bonds, or you can have 0.6 and taking 100% in the 0.6 duration. And those are completely different. The second component of risk in a portfolio like this is obviously the credit component. But again, here, as we showed, using the ETFs in the way we do, you get an exceptional diversification across the different asset classes. We don't believe that you can stock pick your way through credit in the global space. You want to take asset class exposures in a diversified manner. And as we showed, it's about 15,000 odd different names that you get exposure to very efficiently, very in a liquid form, and that should cover the risk component of the portfolio.
Great. Henk, thanks very much. I think it's a good overview of both opportunities. I think just to maybe summarize from a global economic perspective, we expect rates to come down. I think clients that are getting this type of return, which is around, 6 and a bit % in dollar terms, we don't think rates are going to accelerate down, but certainly the cutting cycle will start. So, relative to that, the return will still be very attractive. It's conservatively positioned, again, for clients that are looking for a more defensive position in their portfolio, or more of a diversification stroke balanced approach to an offshore exposure. It's available domestically through a feeder fund opportunity, through the various list platforms that we listed on, which is the majority of them. And then again, should one want to go offshore into a global product, whether it's an endowment or sinking fund, the fund is also available there. So I think, again, nice opportunity. I think in terms of the Prescient philosophy around pricing on our funds, very competitively priced, and being an income fund, we think that's hugely important, even at the feeder fund level. So all around, I think great proposition for clients. Thanks for digging into the detail. I think certainly the investment process is complex, but one would expect that. And it's something that we, from a market perspective, are very happy to talk to. People must please contact us through our colleagues, our business development colleagues in the marketplace. We're more than happy to run you through that should you wish. And obviously at the end of this webinar, as we always do, please post your questions. We'd love to answer them. So in closing, thanks for joining us. Henk, thanks again for your time and input. Please look out for the fund. Fact sheets are available on our website or through contacting our colleagues. And we hope to see you soon. And again, thanks for joining. Thanks everybody for attending and obviously the questions. So let's just get into that. One is particularly around the risk management of the fund. So you tracking a positive 12-month, but there was a question around drawdowns and what sort of drawdown profile you're looking at.
Yeah, so I think the question around sort of peak to trough drawdown, Mike, the short answer is no, we don't have a specific number around sort of peak to trough drawdown. But what is important, something that we do is we run the optimal portfolio, the one that we eventually get towards sort of at the conclusion through the different sort of previous scenarios and cycles, or call it risk events that we've seen, be it sort of Fukushima, be it GFC, etc., and see how the current fund would have performed through that time to give us a very good sense of how sensitive it is through those scenarios, which could arguably be peak to trough and vice versa.
Okay, great. Thank you. Maybe a bit more of a question that's come in from an economic perspective around CPI in the US and the performance target they're looking at. What is the anticipated return, given where we are now, obviously where inflation is, and what you're targeting from a total return for the portfolio?
Yeah, so current US CPI is around 3.2%. So if you add 1.5 to that, getting closer to sort of 4.7, let's call it 5%. The current expected return or forward yield of the fund is about 6.5, so you're getting closer to CPI plus 2.5, which again, for us, it kind of speaks to the opportunity set. As we see inflation normalize, we're still seeing elevated front-end yields, and the opportunity to earn those yields are certainly there.
Yeah, okay, great. Henk, that just then obviously, from it, that's in dollar terms. So again, the pickup above the cash base is using all the assets that you described in the portfolio. So good diversification element, across looking for yield pickup. But one must just ask the question around duration and where particularly the long bond yield is in the US. We've noted obviously that everybody's expecting rates to get cut and the curve will start to look different. What will that mean for the portfolio construction?
Yeah, I think that's a good question. And Stuart asked the question around sort of moving a lot closer on the sort of closer to money market or short on the yield curve, and the rationale for this kind of ties into that, right? If you think about the shape of the US yield curve and really sort of yield complexes around the world, what we are finding is inverted yield curves. And really all that means is you're getting paid less for taking longer term risk than you are getting paid for taking short term risk, and that's the wrong way around. So for us, the rationale is moving shorter on the yield curve. From a risk return perspective, that makes sense for us. If you think about US 10-year at around 4.5, I mean, that sort of long term sounds okay. Not expecting too much, some compression from that perspective. And where we do see compression is from the front end. If you want to be optimal position, that's where you want to be sitting, really front end US rates.
Okay, great.
There was a question around this sort of, is there a ZAR option?
Yes.
So ZAR hedge version. So what we do have is a ZAR fee class on the UCITS fund. So yes, Mike, the answer to that is we do have that, yes.
Okay, so again, that is somebody transferring into hard currency offshore, want to buy the fund offshore, they can buy the ZAR hedged version offshore. Yes. So again, just as a reflection, there are two offerings here. One is you've got the option to buy offshore, and then yes, we have a feeder fund domestically in ZAR feeding off into the US dollar version of this. If we don't have any questions, maybe in closing, what I can just sort of say, just where again we believe this fits into a client's portfolio construction process is somebody looking for offshore exposure but not wanting to take sort of maybe equity risk at this point in time, given their view around sort of the positioning. Certainly what you can do from a high yield pickup option is use the feeder fund for that allocation offshore, or similarly, if you're building a portfolio offshore and want to go and buy the offshore version, that's available on platforms. And so therefore the two are obviously available, and across the platforms or even directly should one require exposure as such. So, the target I would think is for clients in the shorter term view, 3 to 6 months, maybe even longer. What we don't want to do is have clients sitting in this as a short term cash parking space, but obviously, if it is utilized for a more active looking for a position, but I think typically the real benefit is going to be 6 months and beyond. Okay, you're pointing, there's another question.
So I think there's one for Murray there, anonymous, just go down a little bit further around the sort of direct.
So let's just get it. Sorry, just scrolling down.
There we go, a little bit more. Slight IT glitch, but it's around the direct global non-feeder only in endowment sinking funds, not on flexible portfolios. I'm going to hand it to Murray.
No, we do have it then domestically on open architecture list platforms, for example, or should anybody want to utilize the fund in a solution, whatever format that is, if it's available on platform. If not, please let us know and we'll make the appropriate applications or certainly open it up. But yes, somebody can use it on the local platforms which are on a flexible basis to access the feeder. And then, offshore, as I've mentioned, is certainly available on the offshore platforms and endowment stroke sinking funds. Doesn't look like we've got any more questions.
Scroll down to the bottom.
Let's just have one more last take to see if anything's come through. Doesn't look like it.
If there are any more direct questions, please reach out to your different sort of contact points within Prescient, and we're obviously very happy to feed those and come back to you. There is one, what is the split between SA and global issuers, and do you expect global issuers to increase as your process improves further? Yes and no. The process allows us to find the most optimal way to allocate capital in the global income space. If that is to SA issuers, then absolutely those will find its way into the portfolio. If it's more diversified and finding the opportunity set in the different asset classes and diverse sort of opportunities, then that's where we will find it. But certainly relative to where we were, we'll probably see less SA exposure. But saying that, if you think about the sort of real yields on offer for SA specific, there's a reason why there's still some SA in the portfolio.
Thanks, Henk. I think we will cut it there. Thanks, everybody, for joining. Again, please reach out to us. The material is available on our website, but we'd love to engage with you. So please do send in emails or make contact with the relevant people in your region, and we'll be in contact and look forward to talking more about the opportunity that we've spoken to. Yes. Thanks for joining, and thanks, Henk.
Awesome.
Look forward to seeing everybody again. Cheers.
Bye-bye.